So I think we really need to talk. There are some big problems out there. And here in this video, I want to go over just that. This recession, this market crash, what do I think is going to happen? As well as that with Tesla stock. As you know, automakers are not necessarily the best investments during a recession. So I think this information is especially important to all of you guys, and hopefully you take some solidarity out of what is said here in this video. There's a lot of good things to be said, a matter of fact, but here in the short term, not so much. So I want to go over my expectations. We'll talk about how I'm personally hedging my portfolio as well and what my plans are over the next couple of weeks or the next couple of months. Get into some facts to support what I'm saying and everything else. So we got a lot to cover in a very short amount of time. I'm going to try to keep this one a little bit shorter. Hit the like button and subscribe to the channel if you're an investor in Tesla stock or you just like these kind of videos. So I want to start with, we have been basically warning about some kind of downturn for the last couple of weeks now. September tends to be seasonally very volatile, and it's the worst month in the markets. But I've pulled this chart up in a lot of different videos. Okay, I'm sure you guys have seen this by now. Usually the sell-off actually happens in the second half of September, and the first half of September tends to be pretty well. Now, it comes down to quad witching. Now, today is quad witching, and the NASDAQ is down almost 2%. This is significant because, for one, starters, a lot of hedge funds, institutions, and money managers end their fiscal year at the end of September, and a new one starts in October. So this quad witching really can give you an insight on how investors are feeling and positioning their portfolios for the next coming months. And what we're seeing today is there's a lot of hedging taking place. There's a lot of selling of stocks that is taking place. Not too often is the September quad witching down 2% on the NASDAQ. That's pretty rare. There are a lot of negative things happening to the economy right now. Just to name a few, inflation has been high for a long time, and people are really starting to get sticker shock on a lot of different items, and they're starting to pull back. Consumers, they're not doing that well. Look at auto loan delinquency rates. They are now higher than the levels you've seen during the Great Recession. Account level delinquency rates of auto loans 60 plus days past due have risen 26 basis points from Q1 2021 to 1.43% to 1.69% in Q1 2023. This is according to TransUnion. You don't default on your car, the thing you drive to work with, the thing you take your kids to school with, the thing you go to the doctors with, or if you had an emergency to transport your family in. You just don't do that. And I think this is something Wall Street has really been looking past for a long time now. This is not great, and it's not going to end great. Let's be honest. Let's be honest with ourselves. We know this. Wall Street hasn't quite caught on, but today they're starting to catch on a little bit more, as so it looks. The Michigan Consumer Sentiment Survey came out today, and it looks like everything missed. The current conditions came in at 69.8. You were expecting 75.3. That's not great. That's a huge decline month over month. But what is really important is the inflation expectations. The 1 year and the 5 year cratered, and you typically don't see that. And this is even during a time where gas prices actually went up month over month quite a bit, as you just seen from your CPI report earlier this week. This is a sign that consumers are no longer willing to pay higher prices. The consumer is slowing down, and the consumer is starting to expect a worse financial position. If you lose your job, well, you're not going to be able to buy these products. You're not going to expect high inflation. So that's not great, and that's the news that we got today that is mostly having a negative effect on our markets. But you also have the UAW strike, which could drain about $2 billion out of the economy as per some estimates every week the strike lasts. So it's not just the automakers, it's the auto workers that are obviously on strike that are receiving a lot less money, but it's also the other parts manufacturers for the auto industry. Last time this happened in 2019, it was not great. And a lot of people at that time feared a recession. Also have student loan repayments that kick in on October 1st. And that is going to drain over $10 billion a month out of the economy. So that's even larger than the effect of the auto strike. This all comes at a time where you have seen a lot of growth in the past few years, and we're going to see negative growth. The question is, does some of these outsized effects, like the Chinese economy doing poorly, the banking crisis back in May, come back to haunt us and make the situation even worse? How long does it last? Are we going to be in stagflationary territory? Do we go through a deep enough recession to get inflation down to where the Fed needs to cut rates? That's the ultimate bad outcome that could happen in theory over the next 6 months or so. If we go into a recession, but inflation is still 3% the Fed's going to weigh those odds and they're going to say it's not bad enough to get rate cuts. Hopefully that does not happen, but that is a possible outcome. There's a lot more talk now about stagflation than there was before. One of the most telling things about a potential upcoming crash in the markets, or in pertaining to an upcoming crash in the markets, is what Ken Griffin said yesterday. Ken Griffin says he feels anxious about 2023's stock market rally and warns the impact of higher interest rates will soon hit hard. He said, quote, "The U.S. economy is very quickly heading into a recession." Those are not words that you hear very often from a market maker. That is not good. He literally just went against his business kind of logic. Citadel makes more money if more people trade. If he comes out and says, things are not great, we're heading into a recession quickly, that's probably pretty anti-trading philosophy to me. A lot of people are not going to want to go out and trade a bunch or buy a bunch of stocks before a recession. So this actually goes against his own company's business model, what he said. And I don't think he even tried to say this. I think this was one of those things where it kind of slipped out. He didn't mean to be so honest. And I think if there's anyone that does know what is coming, it is the market maker. It is the largest market maker in the world that facilitates about 30% of the trading volume. Now, we broke this down a little bit more in the last video, so go ahead and check that out, actually like 2 videos ago. So definitely go ahead and give that one a watch, but I think it's important enough that all of you guys need to hear this. We are also starting to see the 10-year and the 3-month yield curve that is starting to uninvert. So if you look at this chart, this is a chart from the year 2000 until today. Every time you have seen this inversion, you have seen a recession. Even back here in September, well, late August of 2019, this one inverted 0.5%. A lot of this did have to do with fears of a recession due to the strike on the auto companies. Believe it or not, that was a big reason why this did go negative and people had fears of a recession. Ultimately, that was not the reason we ended up going into recession. It was the Rona. But even look at the year 2000. You don't tend to see pain in the markets during this inversion. You tend to see the pain when it goes up. So this whole time was pretty abnormal in 2022, where you were slowly inverting and there was a lot of pain in the markets. This uninversion is actually where the real selling, the real fear, the real pain tends to happen in the markets, because when you start to uninvert, that's usually before a recession. And then once you start, it usually can go pretty quickly once you do start to head into an actual recession. You can look at the 10-year, 2-year yield curve inversion as well, but the most telling, and the same logic applies for all of the yield curves, but the most telling is the 10 and the 3-month yield curve. You should never get paid out more on a 3-month bond as you will in 10 years. That just never should happen. Now, historically speaking, when you get the Fed cutting rates is usually when the markets fall. Believe it or not, when the Fed raises rates, that's usually not the time where you experience pain in the markets. In 2022, well, it was very much an abnormal kind of year. So you want to be watching the Fed rate monitor tool to see when the markets start to price in rate cuts. Currently, the first rate cut is not priced in until June of 2024. And I think there's probably going to be rate cuts a lot sooner than that. But the first rate cut's not projected for another 9 months or so. So I do think that could just, these expectations can move around based on data pretty quickly, and that could really be a negative for us. If we're expecting rate cuts in June, and then let's say 2 weeks from now, 3 weeks from now, we start expecting rate cuts in January, that's not going to be great for the markets. The first rate cut is not going to be good because inflation is not going to fall enough to get an organic rate cut just because inflation went down. If the Fed is cutting rates, it's because something is breaking. Now, on that note, we're currently still maybe going to get another rate hike. It's not expected yet. The probability for November is 30%. The probability for December is 34.5% for one more rate hike. But pretty much the Fed is already done. So just watch to see if the markets start to price in rate cuts sooner. That's not going to be a good thing. And I do think given we're 9 months out projecting the first rate cut, if the economy does deteriorate, you're very vulnerable to see rate cuts get priced in a lot sooner. And that would be a negative for our markets. Don't be confused. The first rate cut is not positive unless inflation is 2% or less than 2%. And that just does not look likely. Now, the next Fed meeting is 4 days from now. Well, it's really 5 days from now. 4 days, 22 hours, and 56 minutes from now. So next week, the Fed, we're going to get a summary of economic projections. And that's going to be important. That's basically the dot plot of where the Fed thinks rates are going to go. If you get any changes or deviations from the prior dot plot, meaning that if the Fed says inflation is going to take longer to get to 2%, or the Fed is expecting more rate cuts in 2024, the markets are going to look at that as a bad sign. So I'm not very optimistic for the Fed next week. And keep in mind the historical chart, you tend to see a sell-off after quad witching. And just even on quad witching today, you're down 2% on the NASDAQ. It does not look very good. I do think one of the biggest negative things for our markets right now, period, is the expectations for GDP. So Ken Griffin just came out yesterday and said the economy is very quickly heading into recession. Meanwhile, Q3 GDP, which is announced and released on October 26th, is currently being estimated right at about 3%. But Ken Griffin, the market maker that controls 30% of the trading volume, probably the most interconnected person on Wall Street to major corporations, CEOs, companies, governments around the world, well, he thinks we're going into recession, but we have a complete opposite expectations from the market. So someone is really wrong here. And I would make the bet with anyone that heading up into October 26th, GDP expectations probably get cut in half, if not more than that. It's going to depend on the data. It's going to depend on what the Fed says next week. Quite a few things, maybe the trajectory of the markets themselves could also play a role in the GDP estimates. But I think there is room for these to come down, and GDP estimates falling is not going to be a positive as well. And this is probably the number one risk factor that I am seeing for the next month or so, heading into October 26th. Now, specifically with Tesla stock, I'm a lot more constructive based on the simple fact of 50% delivery target. Tesla has been meeting that target for the last multiple years and even exceeding that the last 10 plus years. And Tesla's current estimates are 27% vehicle growth rates for next year and 29% EPS growth rates. The way that Tesla is investing today, leads me to believe Tesla is not anticipating a slower year next year. Now, obviously, the economy could play a role there, and that could obviously affect what the ultimate numbers are for Tesla. But I think it's safe to say Tesla is already kind of priced for a recession. Is already priced for a bad year next year. Given the Cybertruck is coming out, and that is a rolling advertisement, I don't think Tesla is going to miss on these numbers. I think these numbers are too low, even if we do go into recession. As long as we don't see a great financial crisis type recession, as long as something massive doesn't break, in which I'm not really expecting that. Some point in the next 5 to 25 years, we'll see a debt collapse in this country. I'm pretty certain of that, and that's a different scenario. But here in the short term, the next couple of years, I don't see that ultra deep, great depression kind of recession like some people do. But I do think stock valuations are very elevated. And I do think for companies that are trading much richer than Tesla, Apple, Google, even Amazon, Microsoft, Nvidia, some of these companies, they're probably going to come down in a big way as expectations flip, as investors position for 2024. Usually the markets will crash even before the recession starts. And then once the recession starts, usually that's where the big selling starts. But you could just be in the early innings of this. And this is so important because if you're watching this video, you don't have to sit on your hands and watch your portfolio collapse if you don't want to. If you want to hedge out your portfolio, well, you can come do it with us. We're actively doing it. We did it today. We're going to continue to do it as long as the markets are giving us these bad signs and you're getting a pretty clear picture of what's ahead, and that's likely more downside for the markets. We'll continue to hedge. The goal of that is hedge your portfolio, make some gains as your portfolio decays, essentially, if the markets do go through a longer term correction or crash. Take that money, invest it back into your favorite stocks like a Tesla at much lower prices. That's the best of both worlds. So if you guys want to come trade with us, link down below in the description of this video. I'm very optimistic for Tesla next year. I don't want this to come off as, things are going to be terrible. The markets are prone to overreact when company earnings just have been okay and stocks are trading at almost their 2021 valuations. If the markets were down here in the, 375, 385 range on the S&P, I would not be nearly as bearish. I don't expect new lows for the SPY unless the recession were to be really bad. But trading at 443, heading into these major, potentially volatile, bad news catalysts over the next month or two, just does not look ideal to be buying stocks here. It looks ideal to be hedging before you do get a lot of that downside. Even recently, the S&P was much lower, around 431. So how I'm actively going about hedging out my portfolio, it's a mix of, I do have some Apple puts, and I'm really targeting in the short term October 6th to get kind of that short term move, and we've already made, last I checked, it was like 50% on these hedges. So I don't think October 6th is probably the best way to trade this, but even going out to October or November 17th, some of those expirations on like your S&P, on your NASDAQ, specifically I have them on Apple as well, looks to be pretty attractive. Apple probably not doing so well. We haven't seen great reviews of the iPhone 15. For November 17th, you not only cover earnings, but you cover Q3 GDP, and you cover any of the data that comes out from now until November 17th. And I think if there is going to be a major kind of crash event, it's probably going to happen within that time frame. And you can get some very attractive options for that time frame. Specifically on Apple, I like November 17th. Some of the 150 puts, even 140 puts, could be nice if you want to go closer to the money. That's obviously, up to you. That's personally what I'm looking at. As far as the NASDAQ, if you're going out to, let's go ahead and look at exactly the pricing. The NASDAQ's at 370. You could even go down to, the 310 or 320 puts, and you could pretty decently hedge out your portfolio, especially if we do make our way, back down to the low threes or even high twos. That could be a good way to hedge as well. So that's kind of what I have for you here in this video. I wanted to make this video. It's a Friday. I don't think a lot of people are probably even going to see this video. You guys are off doing whatever you're doing, enjoying your weekends. I highly recommend you guys do that, by the way. But hopefully this video helps someone make some money. That's what this video is about. Hopefully it opens someone's eyes to what's happening out there, or what maybe is likely to happen out there. The odds of the markets rising 10% from here are a lot lower than the markets dropping 10% from here. So it's all the risk to reward. There's probably a 2% chance the markets rally 10% from here. There's probably a 98% chance the markets fall 10% from here. That's what I would assign to kind of these percentages. So hopefully you guys kind of got something out of this video. Tesla, specifically, I do want to point this out. Tesla's not going back to the lows. Okay, $100 per share, that's not going to happen. That's not even in Morgan Stanley's bear case scenario. Like worst case scenario, Morgan Stanley thinks 120. I think if we did go through a major crash in the markets, 160 is probably where Tesla would bottom out. That would be if you get a 20 plus fall in the NASDAQ and the S&P, which would be very bad. And at that point, you would make a lot of money in your hedges and you'd be quite happy to pile that money back into Tesla stock at much lower prices. But I think odds are Tesla stock could retrace back to that 200-day moving average. That is at $202.30. That would be quite the fall from here. Quite the fall. So I honestly wouldn't blame you if you did hedge out your Tesla position. But I do think there's a lot more risk with buying puts on a Tesla because you got the Cybertruck delivery event around the corner. We've gotten reports Tesla's going to raise the price of the Model Y in China in October. These are very positive catalysts, as well as, just not even to mention that, the Highland starting deliveries in the U.S. These are not things I want to bet on, so I personally don't have any hedges on Tesla specifically. I think Tesla's in a much better spot than a lot of your other stocks that you could potentially put hedges on. So that is going to do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section, guys. Thank you for watching. Enjoy the rest of your day and your weekends, and I will see you in the next one.